Hey everybody, I wanted to make a quick video and explore whether Lemonade Management's guidance for 2025 for their in-force premium, whether or not that makes sense. Does the guidance they gave 1203 to 1208 of in-force premium for 2025, does that make sense, or do we think it's too low, too high, whatever it is? So I have a little bit here I was going to show you in my Lemonade model. So under this tab called Side Math, which I have just few different things like LTV calculation you can play with, LTV with commission you can play with. It's a few charts in another video where I showed the Lemonade sort of potential present value at 30 or 40 PE across different CAC, customer acquisition to IFP conversions. But down here, I have a little summary table based on different inputs that you can quickly adjust and see quickly, easily see, hey, how might the IFP come in, the in-force premium come in for the end of 2025, the end of Q4 of this year. So the inputs at the top here, I have annual dollar retention, in-force premium at the end of 2024, which was $944 million. Growth spend and an annual base on the whole year, which is they estimate is going to be 40% of what they spent last year, which was 121.5. So that works out to about 170 million roughly. And then on a quarterly basis, see them. I'm not trying to figure out all 4 quarters here exactly, but just lay out the maths in a simple way. What are we going to get at the end of the year to compare this 1203 to 1208 full year 2025 scenario? So I have, just for calculation's sake, that value 170 divided by 4, and then I have IFP from cross-sell, which I've talked about in some few other videos before the Q4 earnings came out, which in the past Daniel had said, I think it was about a year ago, it was about 30%, and we know with Illinois, with car, it went as high as 36%. So I have that at 32%, and then on the side here I have a ratio of growth spend to IFP conversion, or customer acquisition spend, growth spend, whatever you want to call all this 170 million you're spending on your ads, on your conversion of customers. For every dollar you spend there, excluding what's cross-sold, so trying to account for that, eliminate that, how much premium are you getting? And as you can see, I put in, let's say 89%, let's start with 88% for annual dollar retention, because for the last year we averaged about 87% actually, so we could even potentially make that a little bit lower. So let's say 87. Let's put in hold on here, switch that around. Let's say 87%, and this is 944, and this will not change, and that will not change, and that really not going to change. So the main value here to put in is your annual dollar retention, and at the 87% value or figure, you can see that we get a ratio to get to sort of the guidance, of 1203 to 1208, you're at kind of a 1.65, somewhere around that range of a ratio would get you, conversion ratio, marketing efficiency ratio would get you to that amount. But as you can see here on this tab, it shows that conversion, customer acquisition, or growth spend to IFP conversion, overlaid with the overall growth spend that you spent here on the side. As you can see, as you spend more on growth spend, you typically tend to get worse unit economics, which makes sense because your lowest hanging fruit customers are are gone, and then you incrementally, your unit economics are going to tend to get worse and worse with every more dollar that you spend on marketing. But as you can see here, in the last 2 quarters were good data points. We had $39, almost $40 million quarter and a $36 million quarter, and we had a 1.49 and a 1.71 ratio roughly. Of course, I'm guessing a little bit of what the growth spend on these quarters were to sort of back test it, but assuming based on that, you're at that 39 or 40 and 36 million, you're still holding pretty strong at about 1.5, 1.7, about the 1.6 average. So based on that, and based on this, that they're expecting to spend 43 million, I think my conclusion would be, hey, this guidance makes sense, and I don't think they're being hyper conservative. Now, will they get worse than this guidance? It's possible. If they got worse than this guidance, if their marketing was really, really poor, like they had a 1.4 ratio and you only get to 1154, that would be not so great. And even you flip up, to a table like this, it's not, the present value is only between, maybe $20, $30, $40, sort of at the highest value you could make the case for, if that was their sort of ongoing unit economics going forward. But I don't think that's going to be the case, because as they roll out car and push car more aggressively, the unit economics should, if anything, improve. And I think you'll be able to push this blue line higher and higher and still get this conversion line. These pink bars could still be, in the close to 1.8 to 2 range, maybe even better than that, like some of these were, or in a very healthy, I believe, a very healthy standard way. And say they can get to say they get to a 2, then we made the argument that they're worth somewhere between $92 and $144 a share. And if they stay, that ratio stays at 1.8, you can make the argument that they're worth, roughly between 70 to, 120. That's why I've been saying, hey, maybe a fair value for Lemonade right now is, you can argue it, maybe it's $80 to $120 a share. It might be a fair value if they can execute into the future, and you discount that back. But back to the question of the video, was their guidance here reasonable at 1203 to 1208? I actually think it is. There is a chance, though, they beat this. Okay, this is 87% annual dollar retention. If you flip to my model, for the next year, depending on how, I have to look at this a little closer, but depending on how much they roll out car. Now, I don't think, we kind of learned that 2025 maybe is not going to be this huge pedal to the metal year for car, but I do believe car is going to continue to grow. They have said, and I believe this is still their plan, it's under my understanding, that car as a percentage of book is still going to start increasing throughout this year. So as car is increasing, that makes your annual dollar retention better, because you're going to have more cross-sell across existing customers. I wouldn't be surprised, in future years, I have to update this again, but if they really expanded car in 26, 27, if annual dollar retention goes above, 95%, even close to 100% or above 100% is possible, if you have car rollout done in a really aggressive way. But I don't think that's going to happen this year, but maybe more realistic numbers, not 87, but more like 89% for 2025's annual dollar retention. And so if I plunk in 89% there, this is being the main variable to adjust. Well, now, on those same ratios that we were kind of looking at, 1.6 being the sort of center, now you're going to get to 1,223, or about a $15-20 billion beat. So pretty significant beat then on what they're guiding for. And I believe, even in part this year, as one of my preview videos before Q4, I showed that their guidance has been getting closer and better, or at least more accurate. That what they guide for and what realistically happens has been more accurate and more precise. So I wouldn't be, surprised if they have, I still think if I had to pick, I'd probably guess something like this. Maybe they end the year at 1225. 1225 divided by 944. That's still nearly 30%, just on the borderline of 30% year-over-year growth, which would be really excellent growth. You're in that 1.6 range. It's not really where I would want to be on a unit economic basis forever, but I believe because, if you look up here, 1.6 says, hey, we're really worth 43 to $80 a share, somewhere between $40 to $80 a share, if that's sort of the long term in the limit kind of where they can grow their business, continue to grow it at that rate at a 30% annual growth rate until 2032. But I hope they can get higher than that. I hope they, next year's and get to 1.8 or something, and then be more efficient in their marketing. And I expect that as they roll out CAR, that's going to happen, is my assumption, my guess, because if you have 700,000 plus people all across the United States waiting for CAR, and a portion of those people are going to convert with very little ad spend, they're on your wait list, you've signed up, you can contact them for free by email. I'm guessing a portion of those people will sign up for your CAR product, and you'll have really healthy, solid unit economics as you're getting those premium flow in for free. So then that's going to push this value higher, which is, again, why we think you can argue you're more somewhere in here and you're worth more like $80 to $120 a share right now, or would be a more realistic value. But so it's a long story short. I believe the guidance actually, wrong one here. I believe the guidance actually is making sense, but my guess is, depending on what annual dollar retention comes in at, they'll beat it by some margin. And depending on what figure you think, ratio of sort of unit economics you think they might achieve, like maybe with CAR already, maybe they get to 1250. Maybe that's not impossible, but based on how sort of conservative they were with how they talked about, CAR rolling out and still tinkering with things, my guess is the unit economics are going to be more in line with the last couple quarters that we saw, where we had the higher growth spend, where you get kind of the 1.6 ratio, and then you're going to be, maybe something in that range. Maybe the annual dollar retention is a little bit higher, even if that's 90. Well, now you're at 1234, 1234. That's, now you're at that 31% year-over-year growth. So I wouldn't be surprised if something like that happened, or there's a little bit of a beat on that. But that's overall, that's just some thoughts of the ways I'm thinking about how this whole 2025 year could shape up. Hope you can obviously make a copy of my model and play with this yourself. Hope you found that helpful. Thank you so much for watching. Remember, it's in the bag.